Good afternoon, everyone. I'm Jean-Philippe Steins, Senior Economist with the European Investment Bank, and it's my privilege today to present to you a few of the highlights of our forthcoming report on banking sectors in Africa. This report is going to be officially launched on November 22nd, so most people have to wait until then to have the privilege to flip through it. And we will launch it in Addis Ababa, Ethiopia, in partnership with UNIDO. Let me start by giving you a brief outline of the key points I want to touch upon in this presentation. First, I'd like to start with an overview of the recent history of banking sectors in sub-Saharan Africa in terms of their depth, how fast and how deep they have evolved. And we'll see that most African banking sectors have increased their depth by about 10% over the last 2 decades, which is remarkable because it includes the most dramatic financial crisis since the Great Depression. Second, I would like to discuss with you the shifting market focus of banking groups in sub-Saharan Africa. What we'll see is that banks that we survey in our report have evolved in terms of their focus away from multinationals and large local companies and towards a greater focus on SME financing. Third, I'd like to report to you what banks tell us they feel is their main obstacles in deploying more credit to small and medium enterprises in sub-Saharan Africa. Those obstacles are important for us, development partners, because they can inform the type of products, the types of instruments and policies that we put forward to make improvements in this space. Fourth, I'd like to more specifically discuss with you the importance of lending in local currency, so as to shelter banks from currency risks. As banks increasingly expose themselves to local SMEs with revenue streams in local currency, they will need support from IFIs, DFIs, equally in local currency, so that there isn't a mismatch between the ultimate clients of those credit lines, on the one hand, and the credit that IFIs, DFIs provide. Fifth, I'd like to take us at the demand that the banks that we survey report in terms of their needs for portfolio guarantees. And we will see that the glass is kind of half full. Almost half of our surveyed banks report that their needs are being met, but the other side of the coin is that more than half of the banks report that their needs are not being met. So this opens great opportunities together with local currency lending and other policy options that I will mention for IFIs, DFIs, more generally development partners, to up their games and improve the effectiveness of the tools and instruments that they deploy in sub-Saharan Africa to improve lending to SMEs, but also access to finance. And indeed, this will be my 6th point. We'll discuss the evolution of digital financial inclusion in sub-Saharan Africa. And we will see, for instance, that while mobile money, for instance, was an epiphenomenon to be observed in Kenya just 10 years ago, and people were hoping that it would start to spill over in the sub-region, and then hopefully in some distant future to the rest of sub-Saharan Africa, that actually now we can observe the rise of digital financial inclusion throughout the continent, to various degrees, obviously, but this is a source of great hope, but we'll also discuss some of the limitations. There are no questions yet. Let me turn to my first point. So let me just first start by explaining this slide. What we're plotting here in this bar chart is credit to the private sector in sub-Saharan Africa across the different banking sectors. So we look at all the banking sectors in the region and we split them into 4 buckets: first quartile, second quartile, third quartile, and so on. And then this is a trick to see just how the distribution of those banking sectors has evolved as measured by this ratio, which is taken as a rough proxy for banking sector debt. It obviously has limitations, but at least it's measurable everywhere and homogeneously, relatively homogeneously. it doesn't tell you where the money goes, and this is what we're going to get into afterwards. But I'd like to just use this very simple slide to derive some pretty simple observations. First of all, if you look at the median banking sector in sub-Saharan Africa, its depth has increased quite noticeably over the last 2 decades. From 1997 to 2017, we've moved from the equivalent of 10% of GDP, of credit to the private sector, to more than 20%, 21% to be precise. And we can see that there's actually even an acceleration during the last decade, despite, again, the financial crisis that the world has recently suffered from. And the first and third quartile that are there to show you that this is not a figment of the median, that if you look at either the least developed part of the bank distribution of banking sectors on the one hand, and the more developed part, you see a similar phenomenon. In fact, arguably, in relative terms, the deepening of banking sectors in the least developed banking sectors, i.e. in the first quartile, has been more dramatic than even elsewhere, although what's interesting is that it characterizes all quartiles, including more developed banking sectors, which are still going strong in terms of deepening, suggesting that most banking sectors in sub-Saharan Africa have a long way to go before they reach any kind of steady state or optimal depth. Yes?
Yeah, one question. One question. Thank you for the presentation. Does it mean that globally, I mean, taking all the banking sector for the sub-Saharan African region, that they have gained in terms of in depth for the whole continent? I mean, is it true, and is it also confirmed? I don't know if you have the latest data, but confirmed during the last 2-3 years, where we have seen, I mean, a rise in the non-performing loans all over the continent, and also in for some countries, some recessions. So you mean that it's also confirmed during that period?
Well, thank you for that challenging question. I will say yes and no. I would say, look, if you look at the nitty-gritty of the distribution over time, of course, you'll see some countries taking 2 steps forward, 1 step backward. So this is not to say that every single banking sector has been making that kind of progress. That's why we use this sort of statistics to try and sort out the general trends characterizing those sectors. So the answer is sort of yes. I mean, most sectors have been going the right way. But of course, I could point my fingers to a few failures, either temporary or more structural. My answer regarding your second question would be rather no, in the sense that yes, it's correct. The last couple of years have been quite challenging for most banking sectors in sub-Saharan Africa, and we've seen some sort of either slowdown in the deepening or consolidation in some places, sharp rise in non-performing loans, as you mentioned. We believe we are now at the turning point, and that the credit cycle is starting to pick up again, thanks to accelerating growth in at least a large part of the continent. But yes, this has been a rough patch. So while this trend has been strong and relatively stable over the course of these 2 decades, I will not hide from you that this trend has been challenged a little bit during the last 2 decades. I would not conclude that banking depth has decreased, but it stopped accelerating as fast as we used to be. I don't know if anyone wants to use the microphone at this stage, but otherwise, I will I think we're good with this slide. We've discussed it quite extensively. So I would like to move to our next slide. This slide now relies on a survey that I've already alluded to of banking groups in Africa that we run on a quasi-annual basis. So basically, we have a sample of close to 30 banks, banking groups operating in sub-Saharan Africa that we ask questions to. And we ask them all kinds of questions, including related to their strategy in sub-Saharan Africa. And this question asks them, what is the sector that represents your highest priority in terms of business development, for instance? Is it large multinationals, large local companies, retail clients, SMEs? We've done that across several issues, and this is the latest comparison. But basically, trust me, we've seen the sort of trend we see here across the earlier editions as well. The main conclusions to be derived is obviously just how important the focus of banking groups in sub-Saharan Africa is on SMEs. Close to 6 banking groups out of 10 are focusing on SMEs. And this is still rising at the margin. The next, yes?
Excuse me. I have a question on this because do you think that this trend or this picture, that the fact that the SMEs are the focus market for the banks is due to the incentive from EIBs or these international financial institutions that do grant credit line for these kind of markets? Do you think there is a relation?
Well, thanks for that question. To be entirely honest, we can't rule it out. So obviously banks, this is a subjective survey, so banks tell us what they want to tell us. To mitigate that problem, I would mention that we include in the survey not only banks that are client of ours, but also banks that are not client of ours. And while that could be true in explaining, let's say, the level of interest that banks express to SMEs, it doesn't really quite explain the trends, because it shouldn't be, or it's harder to think that 1 year suddenly banks have stronger incentives to tell us they want to work with SMEs, or if they do, it's for the right reasons, not because they're talking to us. So because I've been observing these trends over a few past issues, I am not tempted necessarily to dismiss a potential bias, but to say that there's still something going on. Just exactly the magnitude is questionable. Is the true number closer to 40 rather than 60? That's difficult to say, but the fact remains that we see rising interest from banking groups in sub-Saharan Africa in financing SMEs, and that's just corroborated also by anecdotal evidence, discussions we have on the ground with our clients, and the way we see their capacity developing. I hope this answers your question.
Yes, it does.
So the next thing I'd like to point your attention to is the sharp rise in the focus on retail clients. And that, for instance, doesn't concern us, because EIB doesn't particularly incentivize its clients to work with retail clients. And the reason behind this is because banks have been increasingly relying on deposit financing. This is partly to be related to their focus on SMEs. If they're trying to expand their exposure to SMEs, that's an exposure in local currency most of the time, and therefore they need a matching liabilities in local currency. So there are other factors, but this reflects, amongst other factors, the fact that banks are trying to expand the local currency proportion of their balance sheets, both on the asset and liability side. Something has to decrease in reverse, and that's the strategic priority they put on large local companies and large multinationals. It doesn't mean they've lost interest in them. It means that at the margin, this is not where they're looking for expansion. Because the story is not that large multinationals are not privileged clients that all banks would love to have in their portfolio. The story is that there's rising competition, and if they want to maintain their growth rates and the profit margins, they now need to get out of their comfort zone. And their next challenge is to go out, not maybe after all SMEs, we'll return to that, but at least some of the most solid, those that are reasonably stable financially, have healthy streams of revenue, and that they can make good returns on without taking too much risk at the margin. So I'm going to now tell you about the answers to another question, which is basically we ask our banks, if you were considering expanding credit to SMEs, what do you consider in that process to be the biggest obstacle? And we offered them many more options than this, and they had the option of volunteering an obstacle of their own. But the findings are that the #1 obstacles that banking groups identify is the lack of reliable collateral. And if you've been traveling to those countries, that will not come as a surprise. It's a constant story. The next most cited obstacle is the high default rate. And if you take collateral and default rate together, you've got about 2/3 of the bank's answers. So the 2/3 of the bank's answers center on collateral and default rates, with the implication that there's probably great potential for portfolio guarantees. If this is where their main concern is, then if you could alleviate that concern, then clearly you may have significant impact on their willingness to go forward with a loan that otherwise they would consider as too risky. What we think is another interesting result from this survey is that there is still another remaining 17% of the answers that concerns managerial capacity. I will return to this. We think it's a very important result. It points to the soft side, the demand side of the loan market, and how important it is to make sure that not just banks are capacitated to provide loan to SMEs, but SMEs have the managerial and financial capacity to actually put forward a credible credit proposal or loan proposal, loan request. There are other factors that matters, like lacking information, costly monitoring, absence of good credit bureaus. These are all important things. Many development partners actually subsidize capacity building efforts and technical assistance concerning these obstacles, including EIB. We're making a financial contribution to technical assistance centers known as AfriTax. They're technical assistance centers run by the IMF that provide support to governments in trying, for instance, to create credit reference bureaus, etc. But so that gives you the big picture. I don't think it was necessarily predicated. The point is, we didn't quite know what would come on top. And I don't think there were many studies before that tried to tease out the relative importance of those factors. Everybody knows that all these matter, but really how much and what's most important was what we were trying to find out.
Hello. I'm a little bit surprised by the results because I thought that the lack of financing of SME is more linked to the lack of formal accounts or maybe the cost of monitoring. So how do you explain that almost 2/3 of the SMEs take mention collateral and default rate?
Well, again, we did not have set expectation when we threw that question to banking groups. The thing is that, seen from a bank's perspective, you're not necessarily looking at the whole distribution of SMEs that you could potentially, at the maximum, reach out to and lend to. You're probably looking at the next best SME that you could extend a credit line to. In which case, your most pressing concern is, can I get some kind of credible collateral from this SME so that if that revenue stream they're asking me to bank on does not actually materialize, I can still recuperate at least some of my money. So this probably in some ways suggests that banks are not necessarily looking yet or making a priority yet about the most fragile or least capacitated SMEs. They're still looking at fairly solid SMEs where managerial capacity only worries them to the tune of 1 bank in 5. I would think that if they do their job well in the next 5 to 10 years, and there are more and more SMEs are being lent to, then managerial capacity will become their topmost concern, because the next SME they will want to lend to will not then be an SME they worry about collateral for. They will, but their main concern will be that the CEO of that SME doesn't actually have a solid business plan. So that's my best interpretation of those numbers, but I do agree that this is a good question you're asking. Again, I think this is the first time such questions have been asked to my knowledge, to banking groups, so you're suggesting an excellent follow-up question in the next edition of our survey. Nice time for our next slide. This is yet another question from our survey, where basically we've asked our banks how they see demand for loans in different currencies, be it local currency, USD, Euro, or other hard currencies. And we've asked them whether they felt that demand for loans in that particular currency was either stronger or in line or below market trends. The most striking results from this question, or observation one can make based on this question, is that 3 banking groups out of 10 consider the demand for loans in local currency as stronger than market trends, while the rest of the banks, 7 out of 10, consider it in line with market trends. So this definitely points for a strong market segments along which IFIs and DFIs and development partners could provide support to banks who are trying to expand their balance sheets in the direction of making local currency loans. If you look at the rest of the graph, you'll see that it's not like demand for loans in hard currency is a thing of the past. There's still demand for that. It comes out as weaker, and it shows that there's probably still a role that IFIs, DFIs can play in this space, although it's probably not the next frontier. And it's perhaps no surprise. Even amongst SMEs, you have SMEs that are import and export goods, therefore even SMEs that have their revenue streams in hard currency, let alone multinationals. But it does not seem to be the most dynamic part of the market, based on our results at least. Let me now move on to yet another question, the last that I will illustrate today, that we put to banking groups in our survey. We basically asked them, if you consider your needs for portfolio guarantees, do you consider them as met, partially met, largely unmet, or possibly irrelevant? As you can see, 45%, less than 50% of banking group consider their needs for portfolio guarantees as met. So you can see the glass is half full in the sense that IFIs, DFIs have done some work in this space. It's not like there is no such thing as a portfolio guarantee product. But the flip side of this result is that you've got 50% of banking sector groups that report that their needs are either partially met or largely unmet. And as is perhaps to be expected, it's not something that's particularly new as a message, but here we're able to quantify it and basically get confirmation from banks with a local footprint. There's potentially a large untapped market for portfolio products. Now, let's not be naive. If that's the case, there are probably still good reasons for it. And the reason may have to do with pricing, for instance. Banks locally may have seen some products and decided not to take them on because they consider them as too pricey. Banks and IFIs, DFIs trying to roll out those products may face challenges in estimating just how much to charge for such complicated products that do not lend themselves easily to the standard type of credit analysis that a simple, plain vanilla bank loans would require. So nobody's arguing here that there's a quick fix, but it's hard not to think that there isn't a large unmet demand there and something to be done, especially if you recall that the main obstacles that banks report to be to lending further to SMEs is lack of collateral, and in the high default rates. So this is at least congruent. It's not just banking groups are at least being consistent the way they answer our survey. This is enough for banks per se. I'd like us to take a look a little bit at individuals now. And to do this, I'm going to rely on the World Bank's latest FinDex survey. And I would like us to take a look at the comparison between figures between 2011 and 2017 in terms of account ownership. That encompasses all kinds of accounts, both brick and mortar and mobile money accounts. Bank accounts, these are your traditional bank accounts. Savings products, largely defined, and loan products, largely defined. And there's some really salient and striking observations to be made indeed. In the course of just a few years, this isn't 2 decades, this is 6 years, you've seen a 20% jump in the number of accounts, largely defined, in sub-Saharan Africa, and correspondingly a 10% increase in traditional bank accounts. By deduction, you know that the other 10% is made out of primarily mobile banking accounts. So it's 10% mobile, 10% brick and mortar, evenly split, but still off of a base of 23%, that's a huge jump. So I think we can call that a success. Unfortunately, we'll see that there's several qualifiers to that. The first one is that it hasn't translated very much into a similar surge in terms of the use of savings and loans products. I.e., we suspect that many of those accounts are kind of passive. They're not being used, at least for the type of users that we would wish. Maybe there's a lot of money being transferred, and that's not a bad thing. But when it comes to savings, to using those accounts to save for rainy days, let's say you have a woman who has a family and is stashing a little bit of money aside for in case anybody has a health issue within the family, or for future education purposes and things like that. We'd like to see a greater impact in terms of the number we'd like to see the rising number of accounts be reflected in more savings. Similarly, there's not been that much impact in terms of the proportion of the population that has actually been able to access a loan, regardless of this sharp rise in number of accounts. So it's a bittersweet takeaway on obviously digital financial inclusion and even traditional financial inclusion are improving on the continent, but it hasn't. The rubber doesn't really seem to have been hitting the ground in terms of traction with respect to important products such as savings and loans. Now, let me give you some further qualifiers now. If you compare sub-Saharan Africa to the set of all developing countries, the amount of progress that the region can still make becomes even more visible. You can see that there's, as far as, for instance, account ownership is concerned, there's a 20% gap as of today still between sub-Saharan Africa and developing countries, which is not an unduly demanding benchmark. We're not talking about emerging countries here. We're talking about developing countries. So countries in the same income categories as, more or less, as the sub-Saharan African economies we're talking about. So there's still a long way to go. What's interesting, though, is two more nuanced findings. If you look at the difference between bank account ownership on the one hand and account ownership on the other hand, within developing countries, the difference is only 2%. So that it doesn't. It's only has a marginal impact. If you look at it in sub-Saharan Africa, you have that 10% difference I was referring to in the previous slide. So it's if any progress has been made in sub-Saharan Africa, it's both of brick and mortar, because of brick and mortar or traditional bank accounts and mobile banking accounts. But what's special in sub-Saharan Africa is just how much of that catch-up has to be attributed to digital financial inclusion, which doesn't play a similarly important role in developing countries in general. The other two interesting findings that I think this slide shows is, first of all, with respect to savings product, there is a noticeable difference. Okay, it's not of the same magnitude than account ownership, but somehow in developing countries in general, we've somehow managed to get more people to use savings products. There are probably some lessons to be learned there, some good practices to be imported to sub-Saharan Africa. With respect to loans, the difference is positive, but not very significant. And I think this points to the fact that extending loans to poor population remains a challenge globally for various reasons. Reach. Some of these populations are rural and difficult to reach, whether this is rural Africa or rural Latin America or rural Southeast Asia. You have discriminated populations, unfortunately, all over the world, and that bites there. And therefore, it's equally true that sometimes it's important to adapt existing instruments from one region to another, making sure that they are useful in context, than to say that there are still some global challenges that we need to think carefully about, such as how do we increase access to finance for poor people. There are, of course, a number of strategies that have been contemplated and are being experimented with. My point is that this is work in progress, to say the least. Okay, so that's slowly brings me to an end. But before we get there, I'd like to wrap up some of the findings we've been discussing in terms of both opportunities and challenges. As we begin by arguing, we observe, and these are not the only indicators we have, obviously I've made a selection here for the sake of time, rising competition in African banking markets. And partly for that reason, banks are now incentivized to get out of their comfort zone. They're getting more serious about lending to SMEs. A few years ago, when I used to go to the region, they were talking about setting up a unit for SME lending. And they were very proud about having that project. I've seen SME lending unit, including in Central Africa. So the train's left the station. Nobody's arguing that it's arrived at its destination. But there's something going on that has to do, most likely, with rising competition from Pan-African banking groups, from regional banking groups that are fighting harder together for deposit funding and for clients. We've also seen that there are quite salient potential opportunities for IFIs, DFIs like EIB in terms of local currency lending and guarantees. Banking groups are quite clear with respect to expressing unmet needs in this space. Therefore, more work should probably be spent on designing the right instruments and structures to allow for more local currency lending and more portfolio guarantees. One reason being that the more you're asking those banks to expose themselves to the SME sector, the riskier you make those banks, because they started off lending to the most secure lenders in town, multinationals and large national companies, and now you're asking to go down the food chain to more and more riskier and possibly more interesting in terms of social impact, but more and more riskier clients. The end game cannot be one where we make all these banking groups very risky and where we threaten financial stability in some of those markets. So the risk is somehow to be pooled and shared between development partners. And local currency lending is one way to get currency risk off these banks' balance sheet. And on the other hand, portfolio guarantees is one way to take credit risk. So the devil is in the detail, how appropriate, effective those instruments are so that they strike the right balance. At one extreme, you have pure market instruments that just reflect the pricing of the underlying risk. At the other, you have concessional instruments that include a layer of first loss guarantee or second loss guarantee. There are different options you can play with. And the question then becomes, in context, what's the right instrument? Because the goal is not necessarily to incentivize maximum lending to SMEs. You want to incentivize it up to the point where you've reached out to all those SMEs that are viable. Over-indebtedness is not necessarily the goal of the game here, and I'll return to this in a moment. So financial inclusion is rising, but we've seen that with at least two major caveats. One in sub-Saharan Africa hasn't translated much into significant forays in terms of lending and saving. So there's a lot of accounts being opened. Pardon me. A lot of that probably has to do with transfers, which is a useful service, but probably not the ultimate goal that we're trying to reach here in terms of improving the quality of the livelihood of the people at stake. Yes?
Well, maybe just two questions, especially on your last point, and let me play a bit of devil's advocate. Why do you think that financial inclusion still has a long way to go in sub-Saharan Africa? And additionally, sort of, why do you think it would be a good thing for the depth of banking sectors in Africa to increase?
That's a good question. I think the naive way to answer your question is to say, look at the gap, both in terms of where sub-Saharan Africa lies versus other developing countries. So I'm kind of comparing apples with apples, like countries at similar stages of development. And I'm looking at Africa. I'm looking at how fast it has come from behind and how creative local banking sector players have been in reaching out to the underserved part of the population. And I'm just projecting. I'm saying this, given how creative they are, they're going to reach at least the levels of inclusion we see elsewhere in developing countries. To be entirely honest, I think it's more complicated than that, because this is all predicated on basically the health of the corresponding economies. If Africa was going to hit a rough patch within the next few years, let's say, because the price of primary commodities takes a big dive or things like that. So this isn't a hard science. This is more like trend spotting. You're trying to see, some sort of potential. And to be even more qualified, I'd say, let me go back to my early point, which is, it's not always good. You have to be a little careful here. Within the world of microfinance, for instance, there's the best and the worst, and we all know that. So in most cases, it's been quite good in terms of expanding access to micro-entrepreneurs to credit. But you can't rule out excesses and malpractices entirely either, where consumption has been financed with people getting over-indebted. So I think the problem with these micro figures is it doesn't tell you the fine grain and the how. So just allow me a second of humility. I see a potential. Whether that potential is met and whether it's for better or for good depends on the micro-specific in each context of the quality of the regulation, how well consumers are protected, and I was going to that in a second, how good regulation is, how well supervised those financial actors are, and so on. And all this fine grain had to be glossed over here. So I can only agree with you. I still think there's a lot of potential, but the devil is in the detail in terms of whether or not you actually make a positive impact on people's life. Challenges. Now, these were still opportunities. Now, the real challenges are coming. With every change comes challenges, and one of them here is that as you're reaching out to first-time depositors, we've seen that there's a growing focus of banking groups on deposit collection, which is great. So you have a rising proportion of population and trusting the banks with their money as opposed to more informal financial mechanisms or even just their mattress, with all the problems that this can generate in terms of financial security. But this also raises the question of how secure those deposits are. It wouldn't take much of a bank run to scare off for another generation those first-time depositors. Hence the importance in terms of making this deepening of sub-Saharan African banking sector sustainable, of making sure that it's done in a sustainable way, not just in a cowboy way, but in a way that makes sure that those people will be able to withdraw their money when they want to, and that this doesn't end in tears. And similarly, you also have a widening range of people with access to credit. We also need to make sure that those borrowers are protected. So consumer protection concerns not only just depositors, but also borrowers. As you expand the reach of those financial products, there's always the potential for market abuse by agents. So we always imagine agents as being well-intended people, and we hope that most of them are, but you can't rule out ex ante that some of them be actually in the business of forcing on loans to people who can't afford them, or selling loans for the wrong purpose, and so on and so forth. So this is just an important general point, an important general call for improving consumer protection law in the financial sectors, especially as now we're reaching to more and more vulnerable types of consumers. Similarly, this was pointed out, we've seen recently a sharp rising non-performing loans. We don't think it's directly related to this effort to reach out to SMEs. It's more for related to business cycle reasons. Most economies in sub-Saharan Africa have gone through a rough patch in the last couple of years. But nonetheless, this is a bit concerning, and it raises questions about the sustainability of banking sector deepening in the region. It needs to be addressed. The right way to address this is to strengthen regulation, strengthen the capacity of supervisors, and on the other side, the side of the banks, help banks become better at monitoring and controlling risks. And these are all entry points for IFIs, DFIs, and development partners, depending on their comparative advantage, to come and support the financial development in banking sector in sub-Saharan Africa. I would like to finally return to sort of a more subtle point we made earlier on, which is that 17% of banks that report that their first obstacle, I find this striking, is the lack of managerial capacity amongst SMEs. There's a saying that goes, when you have a hammer, everything looks like a nail. Well, we have credit lines. We sometimes have portfolio guarantee products. So the whole problem of private sector development and SME and of helping the development of SMEs in Africa sounds like a financial problem to us. And it is to a large extent, I'm convinced of that. But the mirror, the sort of the real or Main Street flip side of that is that you need to have bankable SMEs. You can't, as long as you don't have SMEs that can articulate a reasonably credible business plan and provide semi-trustworthy financial statement, it's going to be quite an act to provide them with financing. You're probably going to tell me, well, that's what fintech is all about, and that's right. There are some really smart ways to go around some of those limitations. But at the end of the day, a good business is a good business, and training people to become better managers, better CEOs, better business owners is another low-hanging fruit. So there's space to work to approach the problem from both ends. It improves the ability of banks to assess credit of smaller SMEs, but you can also improve the pipeline of SMEs. And this work will require the collaboration of many actors, because you'll need the involvement of national authorities. You may need concessionality from development partners, and you may need specialized expertise from different NGOs and non-state actors.
One question regarding the non-performing loans. It seems that you consider that the banks, it's the role of banks to improve the control of the non-performing loans, but isn't it just related to the credit cycle or to the health of the economy of a specific country? So why is it just the role of banks, and how should they do? Maybe you have additional suggestions on that.
Well, I think that's good criticism, and it relates to this, when you have a hammer, everything looks like a nail. At the end of the day, financial instruments, financial deepening is just one slice of the challenges and opportunities that need to be addressed in sub-Saharan Africa as in other developing countries. So you will contribute to the healthy development of the private sector by taking the right roads to improving lending to SMEs and access to finance more generally. It also requires that those, similarly as we've argued, that we need bankable SMEs for bank lending to happen. We need well-managed economies for the banking sector to rest on. Wall Street is a reflection of Main Street, as they say in the USA, but that's true all over the world. Your financial sector can only be as healthy as your economy is. Therefore, arguing that it's important to make sure the private sector has access to the right types of resources, tools, instruments, capacity building, initiatives, you name it, is not a substitute to saying that we shouldn't help governments develop their capacity and improve their ability to manage their economies on a macroeconomic basis, and so on and so forth. So I guess I can only agree with you. This is where we tend to see the problem from the angle at which we're coming from. But this also reminds us that at the end of the day, promotion of the private sector is a holistic problem that needs to be addressed from many different angles, not just the financial or purely SME angle. SMEs rely actually on medium and large enterprises. It would be a mistake to let them down or somehow try and squeeze them out of financial markets, for instance. Sure, sure.
Yeah, looking at, again, at those challenges and opportunities, what do you think IFIs and DFIs such as the EIB could or should do to further contribute to financial inclusion and SME lending? I guess you already mentioned some of them, but looking ahead, what do you think can be and should be done?
Okay, well, that's a good question indeed. So let me remind those that we've already pointed out, local currency lending, because this is our work in progress. If they're just already boxed that we could take, I wouldn't repeat them, but I still think that local currency lending, not that it doesn't exist, but just in terms of the proportion of what is being offered in sub-Saharan Africa, should become a mainstream product and take a rising share of what the amount of money that's lending in the region. And you can generalize portfolio guarantees in terms of all kinds of de-risking. There are multiple ways in which you can leverage concessional money to take the risk off, or some of the risk off. Not all the risk necessarily needs to be taken off, but at least some of the risk off to make local actors, international investors more comfortable betting on a good outcome for their investment project and not exclusively in the banking sector. I would say that we tend to see the problem in a little bit of a narrow way, and SME lending, however important it is only one slice of just even the financial sector development agenda. We forget along the way the importance of insurance, micro-insurance included. And it's not all about lending. Savings products are also very important. Perhaps, would argue some, even more important than borrowing products. So they've tended to be neglected, and maybe we should spend more attention to that. Because for a small farmer, and I'm looking at Hannah, in a distant rural area, the ability to save a little bit of money, to buy some fertilizers, to buy some input for her future crop is equally as important, possibly, as being able to borrow to get those input. And unfortunately, the poor are often at a terrible disadvantage when it comes to saving. They tend to save in their own homes or in informal using informal financial mechanisms that sometimes work and sometimes don't work so well. And for instance, women sitting in their own homes can be raided by their husbands, and that makes them more vulnerable. So there are a number of good reasons why, if they're properly regulated and supervised, formal financial products are superior. And finally, I think that we should probably also put greater emphasis on capital market development, because this is where it all comes together. You can't have good savings products if you don't have somehow assets that have been somehow structured in a way that local savers can invest on them. And vice versa, it's difficult for banks to take exposures to assets such as SME loans if they can't churn them off at some point, one way or another, on the capital markets. And most, with notable exceptions like Kenya, Nigeria, and South Africa, most sub-Saharan African capital markets have a long way to go, to put it in a positive light. They have a long way to go. It's there. You can see that there's some progress being made in some places, but there's still a lack of secondary capital markets and products that's still relatively rudimentary. So I think that we should see SME lending and from the broader perspective, let alone of development in general, but that's kind of a given, of capital market development, making sure that banks have access to the type of financing they need without necessarily relying on IFIs, DFIs. The long-term name of the game should be for IFIs, DFIs to make themselves redundant, not necessary for as far as the eye can see. And the key to that is to help African banking sectors develop the financial sector part, the insurance and other subsectors part of their financial sectors. So hope I've answered your question. All right. I think I've come to the end of my talk. I would like to finish off on inviting you again to follow us on social media in the real world if you can make it to Addis Ababa on November 22nd on the occasion of our annual Africa Day. This year, in partnership with UNIDO, we pick a different partner every year so that we share thoughts and perspective. The report will be available in 2 languages. We're quite proud about that, given the split of languages in sub-Saharan Africa, so in English and French. So we hope that this will disseminate good practices both ways. And we'll start make a lot of noise on social media in the run-up to November 22nd. So be sure to follow our hashtags. Thank you.